Hey everybody, it's Grayson. I hope you're having a great day. We're going to jump right into it today and we're going to talk about what the FDIC is. I'm going to go over this real quick to just try to get you up to speed on what this is and if you're even covered. If you've been living under a rock, you might not know that there have been 3 bank failures in the past week. There was potentially another one that was bailed out by its own country. But I don't think this is going to be like 2008 where we saw over 500 banks fail due to the financial crisis and toxic loans. But the high interest environment is showing us that some banks are not stable. So what is the FDIC? It stands for Federal Deposit Insurance Corporation. This is technically an independent group from the regular Treasury, and they handle deposit insurance for banks. Banks pay a membership fee to be a part of the FDIC, and if you ever go into a bank branch or set up an online account with maybe a high interest online savings account, you'll see if they are FDIC insured. You want to make sure that your money is in a bank that is FDIC insured in the United States. This was created back in 1933 as a way to gain confidence in the system during the stock market crash and the Great Depression. People were not putting money in the banks, and this was a big problem. The US government wanted to make sure that people had confidence in the banking system. If they couldn't get the money from people into the banks, banks couldn't lend to other people, to businesses, etc. And this actually does have a bad effect on the economy. If businesses can't get loans, if people can't get mortgages, it's a problem. So this was a way to do that, and it's been around since 1933. Now, the main thing that you need to know is that the limit for insurance is $250,000. The majority of people will not meet this limit. They probably don't have $250,000 just sitting in their bank account. But there are people that have more than this. But here, what is it even cover? Basically this. If you have a banking account which has a checking and savings, and maybe you have some money in a CD, all of those count towards the $250,000 limit. It's not each account, it's total based on borrower. So if you have your own personal account and you have those items, you have up to $250,000 limit. If you have over $250,000 in a checking or savings account, you can just go to another bank and open up another one, and you get another $250,000. So it's based on the account types and the institution. So you can spread your risk around by going to other banks if you have a lot of money sitting in banks. This also includes money markets, but there's also some retirement accounts, joint accounts, trust accounts, employment benefits, and then business accounts, which if you saw the SVB information we talked about, that was a big one for businesses. Now, I'm a business owner myself, and I actually have more than $250,000, but it's not in one account. It's spread across 2 accounts. And the whole reason why I have that much money in there is because I like to keep a good, solid emergency fund because we have a high burn rate in that company. So we go through a lot of cash, and there are people that I have to pay monthly that rely on me. So I like to have a little bit extra cash. If you want to increase your funds or your insurance limit, all you have to do is basically create another account type. This can be a joint account. Let's say you and your significant other can then go open up another account at the same bank you have your personal account in. This is a different type of account. So then each person in that account is up to $250,000. So if it's you and your wife, or you and your husband or significant other, you can have $500,000 in that account. And then you can have $250,000 in your own personal. And then if your significant other opens up their own personal, they then have $250,000. There is $1 million in coverage right there. So the whole point of the FDIC, which is doing its job really, is making sure that you have confidence in the banking system that you're not going to lose your hard-earned money. But if you are over $250,000, like many of these businesses were, they were in the millions, that was just bad money management by them. So that was the quick and dirty on FDIC insurance. Now remember, if you go over the $250,000 limit, you are only covered up to $250,000. For most people, that's not going to be a problem, but if you are over that amount, you can literally easily go open up another checking account at another FDIC insured bank and get another $250,000 limit. You can have multiple banks and just keep growing the limit that way. If you guys have any questions about FDIC, let me know in the comments below. If you guys enjoyed this video, it would be awesome if you liked and subscribed. Is it mandatory? No. Would I appreciate it? I sure would. It would really help out the channel. And I hope to see you next time on Money Shorts.